Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider different points around the investment style and look how the lessons as laid down by its founding father, Benjamin Graham, can be brought into your portfolio to deliver results over the long term. In today's episode, we should be focusing on periods of market turmoil, similar to like we've seen just last week, and consider what we can learn from it and discover how students of Graham can use his principles not only to cope with such events, but also to profit from them. So, without further ado, let's get right to it. Experienced investors will know well that intense periods of market turmoil, like we've just witnessed in the last week or so, are a regular occurrence in financial markets. This particular one triggered in the main by worse than expected employment numbers in the US and fears that this could push the world's largest economy into recession. These figures triggered a worldwide sell-off in equity markets and sent stocks plummeting. So the first question to ask is, was the reaction of the market a logical one, or are we once again seeing Graham's irrational Mr. Market at work? It is true that unemployment numbers did rise by over 4% in July, which was worse than expected. But let's not forget that rising unemployment is the very goal that the Federal Reserve has set out to achieve in order to tame inflation, and the higher rates of unemployment is the evidence they'll be looking for in order to begin reducing interest rates, something that should be beneficial to equity markets. So let's get this straight. What caused the panic was not that the US is falling into recession, but that its economy appears to be slowing, a slowing that the Federal Reserve have been actively hoping to achieve with higher interest rates. The markets presumably feel that the economists at the Fed are not totally in control of the situation, and the odds of a soft landing, whereby economic growth is tamed but without the economy slipping into recession, have receded with this latest set of figures. The market, for some reason, loves all this microdata, believing that it gives them an accurate insight into the state of the economy and of future trading conditions. The reality, however, is that it rarely does. For one, microdata, such as the latest monthly unemployment figures, frequently prove to be incorrect and are later corrected up or down. As well as this, we must consider that the economy as a whole is much bigger than any individual piece of data, and it cannot be assumed what effect this data will have upon it. Sure, taken in isolation, worsening jobs figures are not a good omen for the economy going forward. But if worsening job figures triggers a fall in inflation, which then triggers a fall in interest rates, then borrowing suddenly becomes cheaper, which can then spur investment in businesses, which should of course ultimately result in economic growth. The point is that nothing happens in isolation in the economy. And even if the data proves to be correct, it may not have the effect that would be assumed. In this regard, I put economics in the same box as quantum mechanics, of which the physicist Richard Feynman once said, "If you think you understand quantum mechanics, you don't understand quantum mechanics." The same, I feel, is true of economics. There are simply too many variables involved with the general economy to know where it'll end up with any certainty, based upon any single piece of information. I picture economics like this. Imagine a cork from a wine bottle bobbing up and down in the middle of the ocean. Can we accurately predict where that cork will eventually wash up? We cannot, but we can try to hazard a guess based upon the microdata we have to hand. We can look at wind patterns. We can take into account sea currents and the effect of the tide. But what about the unforeseen factors acting upon the cork? The wake of a passing cruise liner, a journey through the intestinal tract of a sperm whale perhaps. The point is, there are so many differing factors acting upon the cork that its final destination can never be known with any great certainty. The same can be said for the economy. Even data that seems to indicate obvious conclusions cannot always be taken for granted, as competing factors can intervene to leave the ultimate destination far apart from that was predicted. For instance, it did not require an economist to foretell that the COVID pandemic was catastrophic news for the economy. Yet the injection of over $16 trillion in financial stimulus went a long way to ensure that the economic impact was muted. In this instance, once again, the predicted destination was altered by unseen ensuing factors. The point I'm trying to make here, if you'd not already guessed, is that investors place far too much importance on economic news. The fact that job data fell a little bit short of predictions should not have even registered to the intelligent investor. There is a good chance the data will be wrong and later revised for one thing, and even if the data is unaltered and proves to be correct, other competing factors are likely to intervene to make that piece of data an unreliable indicator of the future health of the economy. The fact that the best economists in the world at the Fed, the Bank of England, and other central banks around the world can barely make head nor tail of the data hitting them most of the time should be a warning to investors everywhere that trying to keep track of the direction of the economy by use of microdata is simply a fool's errand. So if we're saying that the economic direction is almost impossible to accurately predict, then how can the intelligent investor guard against being caught out by economic slowdowns? The best form of defence is simply utilising all the skills of value investment as laid down by Benjamin Graham that you've discovered through this podcast series. The best form of defence is choosing the right company at the right price. An undervalued business is of course not immune to the effects of a slowdown, but what history has taught us is that all things must pass, and this includes recession and even depressions. And sooner or later, growth cycles will eventually return by default. By selecting a business that is undervalued, whilst also employing Graham's margin of safety principle, a slowdown need not be a major cause for concern. The margin of safety's very existence is to protect against unknown factors, and this includes economic slowdowns. The intelligent investor will also have to make sure to pay special attention to the balance sheet of the business to ensure that it has capital on hand to weather any temporary financial difficulties that a recession could throw up. They will also ensure that the business does not have large amounts of debt falling due for repayment in the short term, and where they do have such debt, they will be careful to ensure that they are covered by assets that can be quickly liquidated if required. The value investor buys for the long term, and they won't be unduly worried by temporary market dips, which after all are an expected aspect of doing business. The biggest danger lies in not having sufficient funds to get through any temporary phases of potentially diminished profits. This could result in the business going broke before the inevitable uptick in the economic weather. The investor should also not assume that banks will always be on hand to extend credit lines, for often banks are amongst the worst affected during recessionary periods, and lines of credit may not be forthcoming. Providing the investor has used the tools at their disposal to select a business that is sufficiently undervalued, and have employed a margin of safety to mitigate against unknown risks, as well as ensuring the business's finances will allow it to emerge from the storm without reliance on external credit, then the investor need never try to second-guess the economic outlook. Providing all these boxes have been ticked, the value investor, unlike practitioners of other investment styles, should have the confidence of their convictions to remain invested during times of troubles and not resort to the sort of panic selling we see from the general market as a whole. What is absolutely certain is market downturns will occur, and the economists, professional and otherwise, will continue to do a bad job of spotting them. Switch yourself off to the noise of the latest jobs report, inflation figures, GDP growth, and all the rest. Let others worry about the direction of that cork. As the old joke goes, economists have managed to successfully predict 9 of the last 5 recessions. And that ends today's podcast. Thanks as always for joining me. I hope today's vital lesson will arm you with one more tool to successfully navigate the choppy waters of the stock market. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.